This is Tom Fox, the voice of compliance, back again with Matt Kelly, the coolest guy in compliance, for another episode of Compliance Into the Weeds. Today, we're going to take up SPACs, or Special Purpose Acquisition Corporations. Matt, you have written about this. Clearly, you've been thinking about this. What are some of the, perhaps you could start off defining what a SPAC is, and then maybe give us an overview of your concerns.
Yeah, sure. So from the strict legal perspective, a SPAC is a holding company, also known as a blank check company, where a group that forms the SPAC will try to raise money from investors, sometimes with the help of celebrity advisors. We will get back to those celebrity advisors in a few minutes, I promise. But you raise money in a SPAC, then you go public as a blank check company, a holding company. And then basically, this is a holding company that is publicly traded with a big pile of money. You go out, you acquire other businesses, typically private businesses that have not gone public. You've got about 2 years to do it. Or else you have to return the money back to your investors. Most SPACs also are organized around a theme. So you might invest in only medical device companies, or only companies that are green energy, or only companies managed and run by women, or something like that. And then you go forth, you acquire these businesses, you take them public very rapidly, because essentially you acquire an operating business, but you already are publicly traded. So then the next quarter comes around and boom, you have these operating results that you're also reporting. It's a kind of a topsy-turvy way for businesses to go public. And lately, this has caused an awful lot of concern at the Securities and Exchange Commission, which is, what we can talk about here. But SPACs are proliferating like weeds. There are, at this moment, several hundred SPACs. I looked it up earlier today, Tom. There are 552 active SPACs in the U.S. capital markets right now. They have about $180 billion to play with. There are several hundred more that are floating around that haven't gone public yet, that look like they're going to be raising about 60 billion more in capital. And these businesses are going to be floating around. They're going to be scooping up private operating companies and taking them public very quickly. And there are a host of governance and internal control and compliance issues that I suspect a lot of these SPACs and their targets have not yet considered. And very clearly, the SEC fears the same. And so here we are.
So, Matt, you wrote about the internal control perspective from, it seemed to be for entities that were acquired by SPACs, typically non-public companies coming into the SPACs. But I also wondered, I've been thinking about it in terms of when the SPACs might actually take their acquisitions public at that point. But could you tell us a little bit about the concerns you have around internal controls and SPACs?
Well, the problem is, once you are acquired by a public company, that private operating business, it's a public company. And so you have to disclose all the same stuff that all the other public companies have to disclose. So you need strong internal control over financial reporting. Management needs to publish some sort of assertion or opinion about the effectiveness of its internal controls. You have to have all of the disclosure controls and procedures that all other public companies have to disclose. Basically, here we have these private businesses. Potentially, they've been private for many years. A SPAC shows up, and the SPAC is under the gun because they have to do deals quickly. So they show up, they've got a boatload of cash. They say, look, we want to buy you out right now. So here's a pile of cash, and we need you to assure to us that your ICFR is up to snuff before we, the SPAC, go and make those same promises to investors. So there's a lot of concern there that some private businesses might say, yeah, sure. Our ICFR is just great. So when are you going to send the wire? It's going to be that kind of a thing that goes on. I think the SEC is very worried about it. It's also very possible that a lot of SPACs don't know what they're doing. A lot of private companies wouldn't necessarily know what they're doing, because why would they know about being public? They're not public companies, nor are they going the traditional IPO route. which can take a year or two at least and can involve a lot of preparing your internal financial systems to go public. All of that can go out the window if a SPAC is showing up and pummeling you with cash if you'll just close a deal quickly. So the SEC had a lot of concerns about that and published two different statements last week, reminding all of the people involved in SPACs, whether you're the target, whether you're the SPAC, whether you're one of the advisors to either side of this, what these duties would be. And this is only the third warning about SPACs the SEC has published in the last 4 months. So clearly, the SEC is uneasy with the way these things are just proliferating like weeds, and I think with good reason.
Let me pick up on one of the points you raised, Matt, which is the time frame that
Yep.
SPACs have to spend their money, and how that might lead to cutting corners around getting some of these acquired companies IPO'd and out into the public market. Any thoughts on that?
Yeah, so that actually is a good point for the first of the advisories and alerts and like Dear CFO guidance that the SEC published about SPACs. It was, I think, back in December, where you've got about 2 years, if you're the SPAC, to spend the money that you have raised from your investors. And if you don't spend it, it goes back to the investors. Also, if you are an executive at the SPAC who is doing the deals, it would not be uncommon for you, the personal executive, to maybe get bonus compensation for closing these deals and closing them quickly. And if you don't close the deals and the money goes back to the investors, you don't get a bonus or you don't get paid. So you do have potentially a conflict of interest if you're the executive, where it is in your interest to get a deal closed. And so if you are not closing it quickly enough, you might offer more money to the target so they will get over themselves and be acquired. So the SEC's first SPAC guidance back in December talked an awful lot about these potential conflicts of interest and what are the SPACs disclosing to their investors. What are their bonus schemes, their incentive compensation? What about potential conflicts if you're a SPAC and you are looking, you're the manager at the SPAC and you're looking to acquire a business where you have a minority interest in that target? Do you disclose that? How do you figure out what your compensation is? And we could go on all day about the potential conflicts, but the SEC had wanted to clarify that there are a lot of potential conflicts here. There are more SPACs right now than ever before. They are forming more quickly than ever before. And Tom, I'll give you another good statistic I pulled up this afternoon. We had 130 SPACs go public in the first 3 months of 2021, raising about $90 billion. So that is equal to the number of SPACs that went public in the first 9 months of 2020. I don't know if they raised more than 90 billion or not, but SPAC growth is accelerating. And so I think that the SEC is very concerned about what happens about 18 months from now when some of these guys start hitting their 2-year clock, and what conflicts of interest might be amplified by that time pressure. And then what good governance procedures, assurances go out the window because the SPAC manager wants to close a deal, get a bonus, doesn't want to give the money back to the investors. And the private company, again, as I said before, they're just like, yeah, sure, sounds great. What can go wrong? Give us the money. There's going to be a lot of that in about 12 to 18 months. And it could cause a lot of instability.
There's a couple of other concerns you mentioned in your blog post, in addition to those you just articulated, internal controls and governance. Number one is celebrity investors or celebrity advisors, who seem to be ubiquitous right now.
Yep.
The second area really was in the, pull that up, the most prominent private company brought into a SPAC is WeWork. And the prominence of that is because they once tried and failed to go public. And the question, of course, now is, have they cleaned up enough to be able to go public? And what assurances does the investing public have that WeWork now has an appropriate set of financial controls and other controls, corporate governance controls to go public? And then one other point that I'm going to remember after you tell me the answer to those two.
Sure. Well, so yeah, the celebrity advisors, that was the second of the three SEC alerts that came out earlier this year, where the SEC reminded people that just because an advisor such as Colin Kaepernick, Serena Williams, that singer Sierra, I have to admit, I don't know who Sierra is, but she is an advisor to a SPAC. Shaquille O'Neal is an advisor to a SPAC. They are celebrities. And what are they doing to advise the SPAC? Really? I don't know. You tell me, like, for real. So WeWork is a great example that WeWork is a mess of a company, and it had all sorts of funny stuff going on with its founder, Adam Neumann, who tried to go public in 2019. It failed. And then comes the pandemic. So an office sharing startup in a global pandemic when no one's going to the office, that comes under strain. WeWork lost zillions of dollars in 2020. I think it was $3.2 billion. Adam Neumann has been extricated from daily governance of WeWork. And meanwhile, its parent company, SoftBank, is now trying to get a SPAC to acquire the business. Shaquille O'Neal is involved in that SPAC. I don't remember the name of the SPAC, although I do know the investor behind it is a part owner of the Sacramento Kings. And like, what are we doing here, folks? This is a company with serious accounting and conflict of interest questions around it that I think are still not resolved, and plenty of people would agree with me. And here we are trying to see if it can basically leapfrog the traditional IPO market. And floating around in the sort of periphery here is Shaquille O'Neal. And what on earth is he going to be able to advise WeWork about? And is he going to help provide assurances over ICFR? Are other SPAC celebrity advisors going to help out with, I don't know, understanding the nuances of internal accounting controls for FCPA compliance once you're a publicly traded firm? I don't think people like Serena Williams, who I have huge respect for as an athlete, I don't think this is her area of expertise. So what are they doing here? Or are they just basically, there for cosmetic purposes to help drum up more money? So there's a lot of that is going on. And, ultimately it raises some questions for me that's so long. Tom, how many times over the years have you and I talked about how Congress, and particularly Republicans, are worried about the decline of IPOs in U.S. capital markets, which, by the way, is not caused by Sarbanes-Oxley compliance. It's not caused by regulation or anything else. It's caused by much larger macroeconomic trends. But anyway, so is this really going to be a solution to our IPO dwindling market problem? That we're going to wind up with a bunch of holding companies all chasing after a limited number of promising private companies. They're all going to wind up paying top dollar. They're all going to be in a rush job to get the deal closed. And really, we're going to have serious substantive discussions about good governance, board level oversight, ICFR, and investor protection. That's all going to happen while these SPACs are running around like rabid dogs trying to chase down the last promising rabbit they can get a bite out of. I'm hard pressed to believe this is all going to end well.
Matt, SPAC's been around for, I think, around 20 years. Any idea why they became so popular or even ubiquitous really during the pandemic and now this explosion in 2021?
Well, there's a lot of free money. I shouldn't say free money. There's an abundance of investment capital looking for some productive purpose. I'll put it that way. So it can be very easy for people with a lot of capital on their hands just to say, let's form a holding company, and then we'll figure out what to do later on. That is much better than the time-consuming process of investing in a startup, taking it public. That could be a period of 5 or 6 or 10 years or more. There's a lot of work that has to be done. There's a lot of grunt work and board oversight of a startup that venture capitalists do or private equity firms do before they get to the point where they might gussy up the IT and financial systems and then get ready for an IPO. And there's just it's probably that more than anything else is the easy access to capital these days in our loosey-goosey approach to monetary policy and banking policy. And it's got to be spent somehow. So sure, let's do a SPAC. I mean, one example I'll find, and I'm picking them just because of the name. It is called the Queen's Gambit SPAC, which formed late last year after Queen's Gambit became all the rage on Netflix, which is a great show, and you should watch it. But the group Queen's Gambit SPAC is primarily investing in ESG-themed companies that support women executives. And I'm all for ESG companies. I'm all for women playing a greater role in the business world. I don't necessarily know that a SPAC like that is going to be the best way to help investors find new growth opportunities. I'm not sure. And I mean, that's just one example I picked at random. You could pick many, many more if we wanted.
Now, one of the concerns I've had about SPACs is their level of due diligence they may do on the companies they're acquiring,
Yeah.
particularly with these time constraints, but actually more because of this plethora of investment dollars looking for a home to settle in. And I see potentially obtaining privately held companies, which had not gone through the rigor of not only a sort of a SOX 404 ICFR type analysis, but really much in the way of underlying due diligence, and that the SPAC, and more importantly, the SPAC investors could subject themselves to potential liabilities, whether it be antitrust, whether it be anti-corruption, whether it be money laundering, or any of the other plethora of topics that we talk about from time to time on this show. Any real thoughts on that issue?
I do have some thoughts about the due diligence, and so I'll start there. First off, I think all of your questions about who are these private companies and do they have any corruption concerns, I think that's very valid. If I were an acquiring business, I would also be very concerned about cybersecurity and privacy, which are very complex issues under the best of circumstances, but a lot of high growth private businesses that might eventually have gone public in an alternative world and might have paid more attention to due diligence over time. If you're going to short circuit that by throwing a pile of money at that business, they'll say yes, but they might not have had the maturity of their cybersecurity systems or their privacy, and you're going to inherit all of those issues if you're the SPAC. I would be curious also, and this was a point that the SEC had brought up, if you go public, you're publicly traded on an exchange and they have listing standards. So you need to think about, do you have a majority of your board directors are independent? Do you have an audit committee with a qualified financial expert? Are those board members all independent? And if they're not, how are you going to rectify that? And again, if there are all these SPACs forming all of these operating empires, where are we supposed to get all of these audit committee members? They don't necessarily grow on trees, especially if you're looking for skilled and thoughtful people who have the experience to serve on a publicly traded board, which is not the same as somebody who's on a privately traded board or a private business. So there's a lot of those kind of questions. And then, Tom, your point, since you had mentioned antitrust, if you are a SPAC and you're acquiring multiple companies, what are you going to do with them? So are you going to configure them all into some gigantic conglomerate? And if you are, do you have the integration expertise for that? Which, think about segregation of duties, think about policies and procedures for financial controls. It's hard enough to get that for one rapidly growing company, let alone if you are a highly acquisitive firm that's cobbling together a whole bunch of pre-existing companies. How are you going to integrate all of that together? And Tom, I'm going to jump the gun and raise one other issue that I hope you were going to ask me about. Is I had said in one of my posts that I don't know that this wave of SPACs will lead to a wave of failures similar to what we had seen in the early 2000s with the accounting frauds there that led to Sarbanes-Oxley. But I do have concerns that it's going to be more like a bad sequel to that period that gave us Sarbanes-Oxley. It might be more flare-ups, smaller in nature, where really that was driven by Enron and WorldCom and Parmalat and Adelphia and a few other gigantic accounting frauds that happened in the early 2000s that gave us SOX in 2002. Like I don't know what we're going to see here, but probably more like a whole bunch of mini scandals that give you a bunch of black eyes, but not necessarily a gut shot to the capital markets. But I don't see how this ends well for a lot of firms. And I don't see that a lot of investors are going to be thrilled with the results they get from SPACs like about 2 years from now.
Actually, I was going to think of that next. So thanks for preempting me on that point.
Sure.
And unfortunately, we're near the end of our time for this episode, but perhaps we should bookmark or earmark this for 12, 18, or 24 months down the road to see where we're at.
2023, man, we can revisit this podcast and see how right we were.